Everyone, welcome to Medidia. This is your host Umar Tariq. So, some of you guys asked me how much should I save for retirement, how much money should there be, which accounts to invest in. So, I'll try to answer all these questions to the best of my abilities. Let's start with how much should your portfolio be worth. The general rule is rule of 25. So, whatever are your annual expenses, you multiply them with 25. That is how much should your portfolio be worth. So let's say if you're spending 100,000 per year, that's your after-tax expenses, then your portfolio should have 2.5 million, because 100,000 multiplied by 25 is 2.5 million. That's how much should be in your portfolio in order for you to comfortably retire and cover your expenses. Now the next question is, how much can you take out from your portfolio without losing its worth? So that rule is 4%. That means if you have, let's say, a million in your portfolio, you can take out up to 40,000 per year without losing its worth. Generally, the thing is the stock market goes up 7 to 8%. So if you take out 4%, there's still 3 to 4% left, which the stock market would be going up. So you're only taking half of what's increasing over that time period of 1 year. So this is very basic about how much should your portfolio be worth for you to consider retiring early, or even if you're thinking of retiring at 60 or later, and how much you can take out from your portfolio without your portfolio losing its worth. Now the question arises where you can invest. Which accounts? Should you start with a brokerage account? Should you put your money in 401k? So for the purpose of this discussion, I'll be saying that 401k, 403b, 457b plans, I'm just going to put them all together and call them 401k. So initially, I'll say let's start with the discussion of the 401k, which includes 403b and 457. You should try to max it out. What does that mean? The annual limit as of February 2021 is 19,500. So you should try to put as much money as you can in your 401k plan. So what happens is when you keep on putting this money on your 401k plan and you put it on a span of 10 years, 20 years, whenever you take it out, if you take it before 59 and a half, you pay a penalty, 10% penalty. If you take it out after that, or whenever you take it out, you pay tax on your capital gains as well as your initial investment, because your initial investment of 19,500 per year was pre-tax. You didn't pay any taxes on it. So now you have to pay tax on the capital gains as well as your original investment. So that's one option. The other option is Roth IRA. Roth IRA, you can put up to $6,000 per year, and there is some income limits to that. We will talk about that in a second. But Roth IRA, you can put up to $6,000, and those $6,000 are after tax. But what's the benefit? Anytime there's the term Roth, based on my understanding, is that you don't pay any taxes on the capital gains as well as the original investment, because your original investment was after the taxes have been deducted, and the capital gains, the money that grew from your initial investment, you don't pay any taxes on it. Now let's say that about the limit, you're making more money than the limits, you can do something called as Backdoor Roth IRA. So we can make another video on that some other time, but I just wanted you to be aware about this $6,000 after-tax contribution to Roth IRA. So now the question is, what are the limits for the Roth IRA? If you're a single and you're making less than $125,000, you can put money in the Roth IRA. If you're married, the number is higher, and it is kind of around 208,000, I think, in 2021. So that number fluctuates. Just Google based on whenever time period you're watching this video. Just check out what are the Roth IRA contribution limits. And if you're making more than this, like I said, you can invest using Backdoor Roth IRA to avoid paying taxes on the capital gains. Now, how much can you invest in one calendar year in these accounts? So there is annual retirement contribution limit. Roth IRA account is not included in it. So the 6,000 that you put in is totally separate. So that includes your Roth 401k pre-tax, then your post-tax, and your matching from the employer if your employer offers one. So as of 2021, the limit is $58,000. In 2020, it was $57,000. So how is this number calculated? So like I said, 19,500 is what your pre-tax limit is to what you can put in your 401k, 457 and 403b. All your contribution after that is after tax. There's also third category of your employer matching. So let's say if your employer is matching 10,500, so that makes a total of 19,500 plus 10,500, 30,000. But you're still 28,000 less than 58,000. That means you can put 28,000 into your annual contribution limit, and that money, however, will be after tax. Let's say if your employer is not matching anything and it's up to you to fund your annual contribution, then you're putting 19,500 pre-tax. And if you want to contribute more, then in that case you can contribute up to 38,500 to reach after tax to reach the total limit of 58,000 for the year 2021. I repeat, what you can put pre-tax is 19,500. All the contribution after that will be post-tax, which can be at max 38,500 in case your employer is not matching. If your employer is matching, then that comes out from this 38,500. So let's say if you're saying, okay, I am contributing the full 58,000 from my pre-tax 401k, the after-tax 401k, and employer matching, and I still want to contribute more. So remember, there was this Roth IRA or Backdoor Roth IRA that you were already putting 6,000. So now you have a limit of 64,000 is what you're putting in. So there's that, and if there's anything still left over, you can open your own brokerage account and use that for investing. For brokerage account, keep that in mind. All your investment will be after tax, and you will be paying capital gains on the money that you gain from your investment. How much will you be taxed? That depends on how long you hold your investment. If it's less than 12 months, then you will be paying the same amount of taxes as on your regular paycheck. If you hold them for 12 months or longer, then you will be paying long-term capital gain tax. The numbers again change. I think is zero. It's zero capital gain. Long-term capital gain tax if you're making less than 40,000. For 40,000 to something, I think it's 4,000 to 422. Just Google it, or I'll try to put it in the description. It's 15%, and if you make more than 422, your capital gain tax for the long term will be around 20%. So for all practical purposes, your non-Roth 401k, your after-tax 401k contribution is pretty much the same as your brokerage account. Remember, I'm not talking about the pre-tax. I'm talking about the after-tax 401k contribution will be same as your brokerage account, because you're contributing after tax and then you're paying taxes on your capital gains later whenever you sell them, if you hold them for 12 months or longer. Also down there is this catch-up contribution thing. If you're older than 50, you can put $6,500 more to these limits. So rather than 58,000 being your limit for contribution for the calendar year, it will be 64,500. So what that means is now you can put, let's see, close to, you can put $45,000 after tax. After your pre-tax 401k, because your new limit is not 58,000, but it's 64,500. Now, we will talk about the deadlines. So the deadline for your 401k contribution is December 31. All the money should be put in these accounts before December 31st. For your Roth IRA, the deadline is April 15th. So all your money, let's say I'm trying to put money for 2020, I have time up to April 15, 2021 to do that. If I want to put money for 2021, I have time till April 15th, 2022 to do that. Health savings plan. So what is a health savings plan? Health savings plan is a triple tax advantage plan in the sense that you put pre-tax money on it. The capital gains are not taxed. And then you can use that money to pay for your medical bills, pre-tax, so you don't pay any taxes. So it's triple tax advantaged. But there are certain limitations with it. The first one being that you need your insurance plan needs to be a high deductible plan. As of right now, the limits for the high deductible plan is $1,350 for an individual and $2,700 for a family account. If your annual copay limit is less than these numbers, $1,350 for a single and $2,700 for a family, you can't use a health savings plan. So let's say if your annual limits are more than that, in that case you can save, invest pre-tax money, don't pay any taxes on the capital gains, and then you can use money out of that account to pay for your medical bills. However, if you want to use it for anything other than medical bills, then you need to pay the penalty and the taxes. So keep that in mind. Also, one more thing, if you're looking to use it as an investment account, if you hold your health savings account till the age of 65, you can take all the money out without paying any taxes on it. It's pretty much like a traditional IRA in that case then, and only do that after you're 65. The last thing I will briefly touch upon is the Roth IRA limitations. So before making a Roth IRA contribution, keep in mind that in order for you to take out money from your Roth IRA and to avoid paying the 10% penalty, you can't take out money before the age of 59 and a half. So you need to take it out after age of 59 and a half. That's the first limitation. The second limitation is if you plan on taking it out, it needs to be held at least for 5-year holding period. So if you, let's say, start your Roth IRA initial contribution at the age of 55, you need to wait till 60. If you start it at 58, you need to wait till 63. Also, you can take it out before 59 and a half, but then there are exceptions which you can use. Otherwise, you will have to pay taxes and the 10% penalty. What are those exceptions? I'll try to make a separate video on it at some other time, but I will quickly talk about them. First-time home purchase, college tuition expenses, birth or adoption expenses, you became disabled or died and your family is taking this Roth IRA account. You pay for, let's say, unreimbursed medical expenses or your health insurance if you're not employed. So these are some of the exceptions that you can use to avoid paying the 10% penalty. But if you don't fulfill any of this criteria, you need to hold Roth IRA for at least 5 years and then wait till the age of 59 and a half to deduct money out of it. If you're looking to survive this FIRE, or do this FIRE movement, financial independence, retire early movement, then in that case, you need to keep in mind that all these retirement accounts that I mentioned, you can only use them once you're 59 and a half or above. So in that case, brokerage account is a good option, that you use your after-tax money, then you get the capital gains, you hold your stocks for 12 months or longer, and from the capital gains you pay long-term capital gain tax ranging between 0 to 20%, and you use that portfolio to live off it. I hope you find some value from this video. I hope you learned something. If you did, please like it, share it with others, subscribe to the channel, and like I always say, always work hard, never give up, and never lose hope. Bye.